Welcome everyone to the first long form talk of, realistically, this is just David Beheimer and myself. We're making our phone calls public is really what this is, right? So Loan Officer Dave, do you want to say hello real quick?
Hello, I'm Loan Officer David Beheimer over here at Ohio Valley Mortgage, powered by You Mortgage.
So we've been talking a lot about what's going on in the industry, and we sort of realized we normally have like 25, 45-minute phone calls just talking about things. And we kind of realized of like, why don't we just record these conversations and give it to the public? Because it's us talking about rates, how that affects things, and a whole bunch of stuff that the public should know or be aware of. So for our first conversation, let's talk about the thing that I feel like has just become a buzzword at this point: rates. What are they? What are they doing? Why do they keep going up? What's this nonsense?
Yes, I mean, pretty much they're just going to keep. So when I say they, I mean the feds, they're just trying to curb inflation. And basically, until they can feel like they've adequately curbed inflation, they're just going to keep doing these rate hikes that everybody keeps freaking out about. One of the things that I always tell people is that, every time you see a news article that says, Jay Powell decided that he's spiking the rates by 0.25%. That doesn't automatically mean that we immediately, every rate that I just quoted you, an hour ago is now a quarter higher. That's not how it works.
Okay.
Typically on our end, that stuff is kind of all priced in. And then typically it only changes based on if it doesn't occur the way that we were anticipating, if that makes sense. So
can I ask you really quick?
Yeah.
Priced in?
Yeah. So basically, we know they're going to just keep doing the rate hikes. And, like I said, how they said, we're trying to do, two more. Well, I guess now it's only down to one more because they just did the rate hike last month.
Yep.
But when they were saying, oh, hey, we got two more rate hikes, priced in for the end of the year, we're planning on doing two more rate hikes. The mortgage market has already kind of reacted to that and has already kind of planned on their rates going that way for the rest of the year, essentially. But then depending on how the CPI number report comes out, which is kind of like the golden standard of how we measure inflation in the US. Sometimes if that comes in better than we were expecting, okay, well, then that could be more of a green day on the market. If it comes in a little more harsh than we were expecting, okay, well, then that could be a red day on the market. So that's where the fluctuations can happen past that. But where I'm getting at is that when you see the articles that say, another quarter rate hike, that doesn't mean if I quoted you 7% yesterday that now it's 7.25 automatically because Jay Powell just came out and finally hit his gavel. It's nothing like that. It's a little more baked in already.
Okay, and that makes sense. So I guess one question that I think we've talked about before that I've gotten from people: stock market, does that affect rates? Doesn't rates have its own, lending side have its own market?
Yeah, so basically one of the biggest markets that I would say that kind of follows the mortgage market is going to be the mortgage-backed security market, as well as the 10-year treasury. So, and that's kind of just basically more of an indication of how our economy is going, because obviously when everything's going good, rates go down. When everything's going bad, they tend to go up until they get back to good, and then they come back down, with the exception of, I would say, recessions, because historically recessions do lead to rates getting cut, just because at the end of the day, if our economy is in a bad spot, what's the easiest way to get people lending? Cut rates of how people borrow money, and now more people are borrowing money, and it's stimulating the economy.
Yeah, I was gonna say, have a pandemic, I guess.
Yeah,
so casual.
That was great.
So going through that, I think at the end of the day, it's not really rates that matter to the buyers, although that's what everyone seems to focus on. It's more of, what does that rate do to my monthly payment, right? Because it could be a 15-20% rate. God forbid. I'm not saying that's what we're looking for. But What I am saying is the rate percentage doesn't really matter as long as you are making a comfortable monthly payment. Would that be right?
Yeah, no. So, at the end of the day, what I'm kind of coaching all my clients on this year is going to be, obviously everybody's well aware of what the rates are doing.
Mm-hmm.
It's all about kind of getting into the home this year for, more desirable terms, because you saw in 2020, 2021, people were waiving inspections. They're going 30, 40, 50K above ask and still probably not even getting it. Just because there were so many people in the market with those low rates that you have so much more competition for the same house. Whereas now you're dealing with less competition. You're able to start getting seller paid closing costs. The one that we had over the weekend, that guy didn't even need seller paid closing costs, but you just said, hey, let's go for 5,000, and you got that. Could you have done that in 2020?
Probably not. No.
Yeah.
I, we you could get a below ask offer in 2020.
Oh
And
yeah,
I think that's one thing to hit. I'm going to go ahead and try to share my screen really quick. Of
yeah,
it's not necessarily, um, let me know if you can see that, but
yeah,
it's not necessarily that the rates are super low that's impacting us, or super high that's impacting us right now. Realistically, what is impacting us is the months of inventory. So what
yeah,
months of inventory, for people who don't understand, is when essentially how many months on market. So if you have 6 months of inventory in a housing market in like our area, that means if no more houses were listed today, in 6 months, we would run out of all homes for sale. That's kind of how we calculate it. Now, 6 months, the reason I say 6 months, 6 months is considered a healthy buyer seller kind of mix, right? Where you're getting good money for your home, buyers are able to negotiate a little bit more, things like that. This is since January of 2020. We're 1.48 is the highest outside of January of this year at 1.51. That is the inventory we're currently looking at. And
yeah,
the reason 2021 was so aggressive and so significant is because rates were extremely low. People who didn't even need to be in the housing market were in the housing market because it was a why not market, right?
yeah,
Because why not? If I can get 2.25%, I might as well buy something with it, right? Kind of like what you were talking about. So
yeah.
we were looking at 0.53, 0.49. We were at a half month worth of inventory for like 4 or 5 months straight before we came back up to, this seems like a big leap. We're at 0.86. So we're still not even
Not
at
even
the
a full
full
month.
month.
Yeah,
So we've gone up, we've gone down. It's been very much a roller coaster. Even with, I mean, this is August of last year. I would say August of last year is where rates really started kind of staying
yeah,
significantly going up, right, Dave?
yeah,
So yeah, we're at 0.74, slowly but surely coming up. You hit January. I mean, December and January are statistically going to be some of your slower months anyway for selling
yeah,
real estate. But the second we got into the spring market, we're back down. Now we're at 0.9 for June. I did take out in here, I have condo, patio home, single family residence, townhome, and this is specifically for Boone, Campbell, and Kenton. I did take out farm for the property subtype. The reason I took that out is because that farms typically tend to stay on market longer, as well as there aren't as many options. And that the difference really was June was, instead of being 0.99 months of inventory, was like 0.87. So just to kind of give some people context of how I'm searching, I'm looking up residential properties. This is not commercial, condos, patio homes, single family, townhouse in Boone, Campbell, and Kenton.
yeah,
So kind of like what you were talking about, Dave, of rates wise, back in the day, anybody and everybody just wanted to be in the market because of the rates.
yeah.
So
And
that's,
and that's kind of where I was going with all that, is that it's this year's the year about getting in.
mhm,
Yeah, the payment isn't going to be as comfy as if you would have bought back in, 2020, 2021,
mhm,
but you got to go in knowing that you're getting way better terms. You got to run those break even points, which is kind of what I always do for people, because if someone's like, hey, I want that flashy interest rate just to tell my friends that I got a way lower rate this year. Okay, but that way lower rate may cost you thousands of dollars. That the break
mhm,
even point is 3, 5, 6 years down the line.
mhm,
Why do that if we are anticipating rates to drop, ideally in the next 12 to 18 months? Obviously I have a crystal ball. I wouldn't be, working on a Monday, but
mhm,
that's
fair.
just the way it goes. But that's what I'm saying, is that, at the end of the day, we all know the writing's on the wall and they have to come down eventually. So get in the house now, get those better terms, get some lower closing costs, get the whole bells and whistles, and then just know you can refinance down the road.
Mhm,
But I do understand where people kind of get into, their own mindset of like, well, why would I pay more for the same house? And I totally understand that, because, and I don't know if I'm able to share my screen. I know you were asking about like the difference between a six or interest rates in January compared to today.
yeah,
Let's,
I think I gave you permission to.
I'll share screen. There we go. Okay. So on my website here, and I'm trying to get this thing, there we go. I have this little calculator button here, so you can go to a monthly payment calculator. So let's just say on a $300,000 home, I'll just put a realistic down payment, first time home buyers, let's just say they're doing
I'll say
3%.
3 to 5% is what I would guess. Yeah.
Yeah, and I could easily change that too after the fact. So, today the average, I just saw the average mortgage rate nationwide is about 7.25. So let's just say 7.25. So on a $300,000 house, put in 3% down with a 7.25 rate, your principal and interest is going to be 1985. Now, I'm not going to talk about insurance and taxes because
Yeah.
obviously be very property based as well as HOA. This is going to be the number that's actually, kind of what you're more or less borrowing.
Mhm.
But earlier this year in January, I was locking people in at 6.25. So the difference of 1985, dropping this down to a 6.25 is 1792. So let's just see the math on that. 1985, 1792. So almost a $200 a month difference just on the same house 8 months later.
Yeah, $193 difference just on your principal
Yeah.
interest. Again, who knows on insurance and tax and HOA fees, because that's literally a house street. Like that's just, we can't predict that right now.
Yeah.
So I do want to back up. 3% is extremely common anymore, because I have a lot of first time home buyers talking to me about how their parents are telling them that needs to be 20% down. So they
Yeah.
need to save. I mean, 20% down on a $300,000 house, that's $60,000.
Well, and I mean, honestly, the way it is right now, what I've been looking at is, and this kind of goes back to the whole break even thing, is, I try to look at people's debts and things too. When they apply on my website, I'm not just looking at, I've had people saying, oh, I want to throw, 10, 15, 20, 30% down on a house because they have it.
Mm-hmm.
Whereas I kind of try to look at it and I'm like, listen, you're going to end up refinancing this house in the next year, maybe 2 years. Why throw all this money on the roof of your house when you can pay off these other high interest debts? Or, I mean, right now I've been seeing where CDs are paying, 5.5, almost 6% right now alone.
Yeah.
I would rather that you see them put that money in a 1 year CD, get 6% on their money, and then upon the refinance, you can start dumping money into the house, use that money to buy the rate down, things like that. Or at the end of the day, I mean, everybody's kind of in a weird standstill of what's going on in the world economy. Keep that money in the bank. Like it's just, you don't have to do the 5, 10, 20% down if you really don't want to. You can go as little as 3. Now, if you are a subsequent, not a first time home buyer and or above the income limits, you probably need to go closer to 5% down, but that's all kind of case by case basis. I know in our area, pretty much the entire Cincy metro area, our income limit it actually just got raised about $4,000 to 81,000 and some change. I think it's like 81,004 or 500 something. But basically, if you're below that, you can go 3% down, even if it's your 5th house that you bought.
Yeah.
And that also goes off of house, or not household, but qualifying income. So that means if buyer 1 makes 70,000 a year and buyer 2 on the loan makes 50,000 a year, and I can get you approved for this house just with buyer 1's name, we could take buyer 2 off the loan, still put them on deed and title.
Mm-hmm.
And now they get into this program where they get to do 3% down. It typically comes with some lower interest rates and things like that kind of make it a little more enticing.
Yeah, and that's another thing. So Dave, while we're on the screen, if you don't mind humoring me, because I like telling people this, but I also like having the visual for people to see. $300,000 home price. Can we make that 290 and we show what a $10,000 difference is in monthly payment?
Yeah. Do you want me to still put in like the 7.25 one?
Yeah. So at today's rates, we're looking at 1985 on a $300,000 house. Now, let's say the house is 290,000. We're still in the 1900s.
66, yeah, $66 difference. I usually always tell people every $5,000 you finance on a mortgage transaction changes your payments by about, I would say like 30 to 35 bucks a month.
Okay. Yeah, because I was back in like 2017, 2018, 2019. I used to say every $10,000 was about $50.
Yeah.
And that's when rates were not this.
Yeah,
So,
we used to
but
say about 20 to 25 a month back then too.
exactly. But to kind of make it a point of, you could even make the home price 300,000 and then add the down payment was 9,000 and add 10,000 to that. So make down payment 19,000. It's really not going to affect your monthly payment a whole lot. And at the end of the day, it's taking 10 grand out of your pocket immediately, which is one reason of why we caution on, you don't need to put down as much, because brand new appliances can break. Like things can go wrong as a homeowner. There are pros, there are cons to home ownership. So understanding that we'd rather you have that 10 grand in pocket in case, God forbid, HVAC goes out or something, or
Yeah.
fridge goes out, so you can actually have somewhere to store food and things like that, versus save yourself all of $35 on a $5,000 difference.
Yeah, that's what I always tell people. I'm always like, the two things that I would try to go for and consider a transaction a home run is, I don't want you to feel in house poor, and I don't want to watch you drain your bank account to get into something. I
Yeah.
always encourage people to have a nest egg, because I know me personally, when I bought my house in 2018, we bought a 100-year-old house. Within the first year, we had to replace our furnace, our AC, our hot water heater. By year two, we had to fix the entire right side of our foundation. We started noticing really heavy step cracks on the right side of the house.
Mhm.
Had to put 7 helical piers in. That's not cheap at all. So I mean,
No,
like,
that's not.
I've personally seen what can pop up if you're not prepared for it. And that's why we were very adamant about doing the minimum down at first, especially because, I mean, back then, even then the rates were, in the 4s and 5s. So it still was relatively low, where we were like, okay, I don't need to just throw a bunch of money on the house just so I can have a lower payment. I'd rather keep this nest egg in case things happen on this, 100-year-old house. But
Yeah, and that's the same conversation I have, especially first time home buyers right now. Of I would much rather it does. Yes, do rates matter? Yes, like you need to pay attention to it. I'd much rather you focus on what that monthly payment is. Do you feel comfortable with that monthly payment? Because yes, is it a good thing to own a home? Absolutely. There's equity possibilities. It's an investment, and yet at the end of the day, if you can't afford to go grab drinks with your friends or go on a vacation here or there, I
yeah,
don't want to the point of you can't afford to leave the home you've put yourself in. That's
yeah,
not the purpose of buying a home. And if that's what it's going to be, don't buy a home right now.
yep,
Just straight up. There in this market currently at 7.25% interest rates, there are people who should not be in the house buying market.
yeah.
They just shouldn't be. There are people that you and I have talked about before that absolutely should be, but this is very much a I need to buy and sell market, not a I want to buy and sell market, which were the last like 3 years because of the rates being where they were.
Oh
Now,
yeah,
next year, inventory probably isn't going to be fixed like that.
yeah,
I don't anticipate over a 3-year stretch us having 1 month worth of inventory essentially being our highest.
yeah.
Um, I don't I don't foresee inventory just skyrocketing to 6 months immediately.
No.
That being said, inventory still being low. Next year's an election year, a re-election year on top of that.
Yeah.
President is running for re-election. What do we historically see during re-election?
Rates always end up dropping during re-elections. I think it's one of the last like 7, every single one has dropped or something like that. Don't quote me on it. I don't have the stats in front of me, but I know like historically, a majority, if not all the time, on election and re-election years, rates tend to go down.
Mhm.
So yeah,
So what I'm trying to get at is, again, we do not hold us to we can't promise anything. Nobody predicted 2020. No, nobody.
disclaimer.
And if they did, they knew about it beforehand somehow. So at the end of the day, what we are looking at historically is likely rates are going to go down next year. So if you're looking to buy, it might be a better option to buy with a higher interest rate. And I'm going to put a clause on this of that a monthly payment that you are comfortable with still. God forbid rates do not go down next year. You still need to be in a comfortable monthly payment range, whether they go down or not. However, if you buy now with rates being higher and less buyers in the market, dealing with this inventory next year when rates do go down to whatever number they do, they're going to be more appealing. More buyers are going to get into the market. We're going to be in a worst case multiple offer situation more than likely.
Oh yeah, I mean,
I
as
mean,
soon
that's
as
what we've seen the last 3 years.
I would imagine, as soon as these rates hit in the mid 5s, people are going
Mhm.
to start coming on droves. Because I mean, actually, here, let me. I know I
I
just
mean,
stopped my screen, but
yeah, while you're pulling that up, I mean, I have had conversations with sellers talking about, look, I could stomach like a 5.25, a 5.5 with my 3.25 rate right now, but I don't need to make any moves. They've got all this great equity in their home to buy their next home, but there are sellers I'm talking out of it. Of it doesn't make sense. It's not your dream home. It's not a necessity. You just
yeah,
don't need to. Financially, it is not a good move for you right now.
yeah.
So yes, 5.5.
So I mean, if we go just from 7.25 to 5.5, so 1985 down to 1652. I mean,
Mhm.
that's $330 a month, $333 a month
Mhm.
drop just in a less than a 2% drop in rates, which, I mean, I remember the pre-COVID normals were 4.5 realistically,
Mhm.
which is what ideally we would try to see back again, once we get out of this rising rate environment, come back down to I always say the pre-COVID normals, because when I say coming back down to normal, some clients will say, oh, so 2 and 3% is coming back. And I'm like, no, that's
Yeah.
never coming back. I mean, if you look at the history of interest rates over the last, 15, 20 years, you're going to see that it sits right in that 4 or 5 pocket, maybe, a dip and a raise here and there, but like 4 and 5 is kind of the sweet spot for a healthy economy. So
Yep.
the closer we get to that again, that's when we're going to start to see more people. And honestly, it's just going to be, I think it's going to be almost like a 2020, 2021 all over again when these rates do drop down. That's why I'm hoping it's going to end up being a little bit more gradual than abrupt of, let's just say it keeps rising, keeps rising. They finally declare something crazy like, oh, hey, we're in a recession, we're going to cut interest rates. And then, if it abruptly drops, you're going to see people come out in droves. Whereas if it kind of slowly comes down, you're going to slowly start to see people feed back in
Mhm.
that maybe were kind of sitting in the sidelines waiting for things to come down because, like we said, they just weren't comfortable with that payment on that house. But yeah,
Yeah.
I mean, yeah,
I really do think the high fours, mid fives are going to be like the industry norm going forward,
yeah,
depending on what inflation versus whatever we're going through needs to be battled. However, yeah, right now with where we are, there's plenty of homeowners that I have talked to that are just waiting on the sidelines for a number that makes sense in order for them to pull the trigger of. I've got a lot of people wanting acreage and building
yeah,
in Pendleton, Southern Kenton, Southern Campbell. I've got quite, and it's just one of those making that move when the rates make sense.
yeah,
Um, Overall, it's interesting to see how the rates affect the monthly payment. I mean, again, like you said, we went from 7.25 to 5.5, and it dropped over $330,
yeah,
just like that. So I do get why people are where they are with things.
yeah.
I do think it's very important, like you stated, COVID was an anomaly. The last like 3 years, an anomaly. So when we are talking normal, we are talking fives as
Yeah.
normal, not 2.25. Because I've had people DM me on Instagram when I'm talking about real estate stuff, and they're like, "Oh, just hit me up when my rates are back down at 3.25, so I can refinance." And I go, "Okay, I will never hit you up then. I don't
We'll
think
never come by.
unless something like 2020 happens again, I do not, and I don't even think if something like that happened again, rates would drop like they did, because I think they artificially held them down too long, which
Oh, yeah.
caused a lot of these issues.
Yeah.
So overall, I I just think it's an interesting market that not a lot of people can even really remember what was before 2020. You know what I mean?
Oh, yeah. Yeah, and I only remember it just because I mean, I bought my house in 2018. And I think I
Mhm.
refied in 2019 and then again in 2020 because why not? But
Mhm.
yeah, I mean, that's what the normal was fours and fives kind of teetering, bouncing up and down between those two numbers until 2020 and everything just shot down. And then people were just buying in droves, which, I remember when 2020 first started, it was a really weird time. Like you didn't know if you could go outside. Everyone's talking about it being airborne and like it was super scary in the moment. And now looking back, we're like, oh my God, I should have bought 20 houses then.
Yeah.
Like
Yeah.
I keep track of all my closings like just over the years. And I saw that at the end of 2021, like September, or no, it was November of 2021, I locked in an out-of-state investor on a duplex in Cincinnati for a 3.625 interest rate.
That
Like,
so
I was like, what do
I
you
want
do?
people to understand, a non-primary
Oh,
loan
the rates are even
rates
higher.
are not the normal residential. That
No.
that that sounds like a normal residential rate at that
That's
point.
what I literally, so I periodically I'll go back and I'll call old clients just to, just to touch base, see how they're doing and everything. And I don't ever want to come off like a pushy salesman or anything. I'm just like, so I called everybody from 2021 and I was just like, hey, you're never going to refinance. How does that feel? How does it feel having that rate? Like, I don't even want you to refinance. Like the only time, like right now, even, I guess I will touch on this, that the only time I see people wanting a refinance or when I would encourage a refinance in this market is if people have consumer debt piling up, and I just made a video of this a couple days ago on my Instagram and TikTok, but like, we are starting to see, I think, what was it, like last week, they said that the consumer credit card debt across the US finally crossed $1 trillion.
Mhm.
So, I mean, people, they're, they're sitting on these low rates and they love that low rate. And I tell people all the time, I'm like, dude, if you can keep that forever, please do. Like, don't get rid of that by any means. But if you are financing the living room set and the back patio furniture, and you took out a installment loan to consolidate some of those debts, and you have these, high interest rate debts, it may make sense to pull that equity out of your home and pay off these debts. Like, I saw someone who went from a 3.25 to a 7% cash out refi earlier this year. And even though, yeah, his mortgage payment went up $200-300 a month, we were able to knock off $1,700 a month in monthly obligations by using his equity. Because that's the one thing he said is, man, I want to do this cash out refi, but I don't want my mortgage payment to go up. And I just kind of had to have that reality check with him that it's 100% going to go up.
Yeah, there's no way it won't.
Yeah, you can't look short term with this of, hey, this is what's going on. You got to look at the fact that now I'm saving $1,700 a month. So the net gain is $1,400 a month on your money to take that higher interest rate. So, that's the only time that I'll recommend it. But at the end of the day, man, like, I just call my clients every so often and I just say, like, hey, you're never going to refinance. How does that feel? How does it feel knowing that you have a 3.625 interest rate on an investment duplex where everybody else that bought in the last basically in the last year and a half is sitting probably in the 5, 6, 7s? So
Yeah.
it's crazy.
And that's one of the clientele that I'm dealing with right now. Of I've got sellers who either they're refinancing with you and everything, or to pay off their debt consolidation, or we're having that honest conversation of, look, you can pay off your car, you can pay off your $20,000 to $30,000 of credit card debt, you can pay off your student loan right now. We sell your property, you take all that equity, you get this much back estimated net. I go through with them because it's important to know what you can list your house at. But every single time I meet with a seller, I say, here's what an estimated net. You would walk away with at the closing table. How do you feel about that? And going through that, we realized if he just sold and rented for a year or two just to do whatever he needs to, because he wasn't even sure if he wanted to stay in this city for much longer.
Yeah.
He was thinking about transferring. So, okay, how about we pay off all of your debt? You rent for a year to figure out what you would like to do and not feel locked down of, I've got to get the house ready, I've got to do this and that. And we just figure it out after that. But if we can wipe all your debt away because of the equity from your home from buying in 2019, let's do that. So those are some sellers that I'm talking to right now of, that's actually not a bad idea. Kind of like, again, your alternative would be, let's refinance and just go from there and just help pay off that significant amount of debt. You are a clean slate and there's nothing else to worry about other than where's your rent payment going.
Yeah. Yeah.
So
I think it's a great idea. I mean, the biggest thing is obviously, everybody wants us to be biased and, it's buy, you need to buy. But like, at the end of the day, I had a background in multifamily housing. I know sometimes it does make sense for people, especially if they do want to be a little more transient and they don't know if they're going to be here. They don't know what they want. They're still, figuring themselves out if they want to be here, where they want to live, things like that. And that's another great thing about renting too. You can lock yourself in for, I've seen people do 3-month leases. You can do 3, 6, 9, 12, 24-month leases. And okay, I want to try living in the Hyde Park, maybe Oakley area. And then, okay, now I want to try living in Cold Spring, Kentucky. Like, you can kind of bounce around and see, where do I want to live more long-term? And once you figure that out, then yeah, maybe it makes sense to buy. But yeah, it's all the people who make those videos about like, oh, you're stupid if you rent, you're just throwing your money away, this and that. Like, no, sometimes sometimes it makes sense to quote unquote throw your money away. And really all they're saying is you're not gaining the equity, which, yeah, that stinks. But at the end of the day, like, what makes more sense for you?
Yeah, realistically, you're giving yourself that freedom of, I can be here this year, I can be here next year, and just make those moves. Make that. I mean, there are people who I know they can't commit to even like a normal pizza place, let alone where they're living. I have buddies who they like to move around, they like to change their space. I get it. That's their lifestyle and that's what they should do.
Yeah.
However, if you are looking to stay in this area, might make more sense to buy. However, that's why we have discovery calls with them of, what are you looking to do? What are you looking to get out of it? Because I mean, the amount of times we've talked to people like, no, you don't be in the business right now. Don't buy, don't sell.
Yeah.
It's a lot more open of a conversation, and that's what I kind of appreciate about this industry. You can kind of do as you please.
Yeah,
So
exactly.
so okay. Well, I think this first talk went really well.
Yeah.
If anybody has
We can
questions,
rank them slightly.
yeah. Hey, we avoided now that we're here to the public, we're avoiding our rants on different
Yeah.
people. So,
We're keeping it very tame now. Yeah.
exactly. But no, if anybody's watching and you do have questions or you want us to cover a topic, we're looking to do this. I'm going to say bi-weekly. Um, for now, we're looking to just have these long form, just post a raw conversation of us talking. These are our normal phone calls anyway. Probably with a little bit less yelling at dogs to be quiet and stop barking. But overall, yeah, this is our conversations we have 2-3
At
times a
least
week
once a
anyway.
week. Yeah, one to
Yeah.
two, maybe sometimes three if we're having a really fun week that time.
Yeah, if it's a really interesting week. But overall, yeah, if anybody has any questions, anybody has any topics they want us to cover, um, anybody has suggestions on what I do with this background and not have the light reflecting in my whiteboard, whatever you want to do. But David, thank you for being on.
Yeah, thanks for having me.
We will talk more topics at a later time, and looking forward to getting more into it.
Yep, sounds good, man. Thanks for having me.
All right, I'll talk to you.
See you.